Hi, in this video, we will discuss the fifth and final method of adjustment of capital at the time of retirement of partner. The fifth method is when the retiring partner is to be paid through the amount which is brought in by the remaining partners in a manner to make their capitals proportionate to their new profit sharing ratio and also leave a desired bank balance. So the retiring partner will be paid off. The remaining partners will bring in cash when necessary. The final capitals of the remaining partners will be in their profit sharing ratio, and the cash brought in by the remaining partners will be in such a way that a desired bank balance remains at the end of the reconstitution. That is, at the reconstituted balance sheet, a desired bank balance is maintained. So let's go to the steps to be followed under this fifth and final method of adjustment of capital at the time of retirement of partner. Steps to be followed. First step, pay off the retiring partner. So the retiring partner's capital account will be closed by paying cash. Step 2 is to calculate the adjusted capitals of the continuing partners. That is the balance of their capitals after all adjustments with respect to revaluation gain or loss, reserves, accumulated profits and losses, and also goodwill treatment. The step 3 is to ascertain the total capital of the new firm. The formula to be applied is we need to get the total of the adjusted capitals of the continuing partners. We need to add the amount which is paid to the retiring partner. We also need to add the desired bank balance which is given in the question. And from this amount, we have to subtract the existing bank balance which will be given in the balance sheet. The next step 4 is to ascertain the new capitals of the continuing partners. For this, we have to divide the total capital of the new firm. That is the answer of step 3 in the NPSR or new profit sharing ratio of the continuing partners. The final step is to pass the following entry for the amount which is equal to the amount of the new capital of the partner, which is the answer of the step 4, minus the adjusted capital of the same partner, which is the answer as per step 2. Bank account debit to partner's capital account, being cash brought in by the continuing partners. So these are the 5 steps to be followed in this fifth and final method of adjustment of capital. We'll continue to do a very small example sum so that we can understand the concept better. Example sum. X, Y and Z were partners sharing profits in the ratio of 5:3:2 respectively. Y retired on 31st March 2019. On that date, the capitals of X, Y and Z after all adjustments stood at rupees 43,200, rupees 36,600 and rupees 11,200 respectively. Cash and bank balances on 31st March 2019 were rupees 4,000. Y was to be paid through cash brought in by X and Z in a manner that their capitals are proportionate to their new profit sharing ratio, which was to be X 3/5 and in the case of Z 2/5. We are asked to calculate the amount of cash to be paid or brought in by the continuing partners if minimum cash and bank balance of rupees 3,000 was maintained. Pass the necessary journal entries also. So the statement that Y was to be paid through cash bought in by X and Z in a manner that their capitals are proportionate to their new profit sharing ratio. And also, in the last sentence, in the second para, minimum cash and bank balance of rupees 3,000 was also to be maintained. So this tells us that this is the fifth method of adjustment of capital at the time of retirement of partner. So let's begin with the working notes. Working notes. Step 1. The retiring partner is Y and we need to pay him off. So the step 1 is pay off partner Y. The amount due to him is rupees 36,600. We'll pass the journal entry later. Step 2 is to ascertain the adjusted capitals of the continuing partners X and Z. In the case of X, it's rupees. The second sentence, on that date, the capitals of X, Y, and Z after all adjustments stood at. In the case of X, it's 43,200 rupees. And in the case of Z, it's rupees 11,200. The step 3 is to get the total capital of the new firm. We'll add up the adjusted capitals of the continuing partners, 43,200 plus 11,200. We need to add the amount which is paid off to the retiring partner Y plus 36,600. We also need to add the desired bank balance. The second para says calculate amount to be paid or brought in by the continuing partners if minimum cash and bank balance of 3,000 was to be maintained. So the minimum desired bank balance is rupees 3,000. And from this, we will subtract the existing bank balance on 31st March 2019, which is the date of Y's retirement. It says here cash and bank balances on 31st March 2019 was rupees 4,000. So we'll deduct 4,000 rupees from this amount. And the final answer which we get rupees 90,000. Step 4 is to get the new capitals of the partners, continuing partners X and Z. By taking the total capital of the new firm, answer of step 3, 90,000, and dividing it in their NPSR. The last line in the first para says NPSR between X and Z is 3:2. Hence, for X, 54,000 rupees. And in the case of Z, it's rupees 36,000. The final step 5 is to compare adjusted capitals and the new capitals. In the case of X, adjusted capital is 43,200 rupees, whereas the new capital is 54,000 rupees. So X needs to bring in rupees 10,800 rupees. In the case of Z, the adjusted capital is 11,200. The new capital is 36,000 rupees. So Z needs to bring in 24,000 rupees, 24,800. So let's pass the journal entries. Solution. Journal. Date. Particulars. LF number. Debit rupees and credit rupees. The date of retirement of partner Y, 1st April 2019. Journal entry for paying off partner Y. Y capital account, debit to bank account. Amount paid to Y is 36,600 rupees. Being partner Y paid off. Second journal entry, same date. We'll pass a combined entry for X bringing in rupees 10,800 and Z bringing in rupees 24,800. Bank account, debit to X capital account to Z capital account. Amount brought in by X, 10,800 rupees, and amount brought in by Z is 24,800 rupees. So total amount 35,600 rupees. Narration. Being cash brought in by partner X and partner Z. So these are the two journal entries, the answer to this example sum.